how the Federal Reserve actually controls interest rates, and why it matters for your money. Most people have heard the phrase the Fed raised rates or the Fed cut rates. It shows up in headlines, it moves markets, politicians argue about it. And yet, if you ask the average person to explain exactly how the Federal Reserve controls interest rates, not just that it does, but the actual mechanism, most would struggle to give you a clear answer. The gap between headlines and understanding. That gap matters because interest rates are not an abstract concept. They determine the cost of your mortgage, your car loan, your credit card balance. They influence whether your savings account earns anything meaningful or sits dormant. They shape hiring decisions, business investment, and the valuation of nearly every financial asset on the planet. So today, we are going to close that gap. This is a complete, ground-up explanation of how the Federal Reserve actually controls interest rates and what that means for your financial life. Section 1. What the Fed is and what it is not. Let us start at the foundation. The Federal Reserve is the central bank of the United States. It was created by an act of Congress in 1913, following a series of devastating financial panics that exposed how fragile the American banking system was at the time. The idea was to create a lender of last resort, an institution that could stabilize the financial system when private banks could not. Established 1913, lender of last resort. The Fed is not a government agency in the traditional sense. It is an independent institution, meaning it operates without direct control from the White House or Congress. The chair of the Federal Reserve is appointed by the President and confirmed by the Senate, but once in office, the Fed makes its own decisions. This independence is intentional. The theory is that monetary policy, the management of money supply and interest rates, should be insulated from short-term political pressure, independent from direct political control. The Fed has a dual mandate, established by law. Its two primary goals are maximum employment and stable prices. These two goals are sometimes in tension with each other, and navigating that tension is at the heart of everything the Fed does. Every dual mandate, maximum employment plus stable prices. Now, here is a critical distinction that many people get wrong. When we say the Fed controls interest rates, we are not talking about every interest rate. The Federal Reserve directly controls one specific interest rate, the federal funds rate. Everything else flows from there. The Fed directly controls the federal funds rate. The federal funds rate is the interest rate at which banks lend money to each other overnight. Banks are required to hold a certain amount of reserves, essentially cash on deposit with the Fed. When a bank ends the day short on reserves, it borrows from another bank that has a surplus. The rate charged on that overnight loan between banks is the federal funds rate. The federal funds rate, now overnight interbank lending rate. The Fed does not simply decree what that rate will be. Instead, it sets a target range, typically a quarter-point range, and then uses specific tools to keep the actual rate within that range. The Fed sets a target range, not a decree. Section 2. The tools of rate control. This is where it gets genuinely interesting, because the mechanism by which the Fed achieves its rate target has changed dramatically over time, and understanding the modern system tells you a lot about how money itself works. The old system, open market operations. Historically, the Fed's primary tool for controlling the federal funds rate was open market operations, buying and selling U.S. Treasury securities in the open market. Here is the logic. When the Fed wants to lower rates, it buys Treasury bonds from banks. In exchange, it credits those banks' reserve accounts with new money. More money in the banking system means banks have more than enough reserves. So when they lend to each other overnight, they compete to find borrowers, pushing the rate down. Fed buys bonds, reserves increase, rates fall. When the Fed wants to raise rates, it does the reverse. It sells treasuries, pulling money out of the system. Reserves become scarcer. Banks compete to borrow rather than lend, pushing the overnight rate up. Fed sells bonds, reserves decrease, rates rise. For most of the Fed's history, this system worked because banks held minimal excess reserves. They kept just enough to meet their requirements and no more, because idle cash earns nothing. So small changes in total reserves had an outsized effect on the overnight rate. The post-2008 system, interest on reserve balances. Then came the 2008 financial crisis. The Fed responded with massive asset purchases, what became known as quantitative easing, injecting trillions of dollars of reserves into the banking system. Suddenly, banks were swimming in excess reserves. The old scarcity-based system stopped functioning. You cannot control a rate through reserve scarcity when there is no scarcity. 2008, quantitative easing flooded the system with reserves. So the Fed adopted a new primary tool, interest on reserve balances, or IORB. IORB interest on reserve balances. The concept is elegant. The Fed simply pays banks a set interest rate on the reserves they hold at the Fed. If a bank can earn a competitive rate just by leaving money parked at the Federal Reserve, it will not lend to another bank at anything less than that. The IORB rate effectively becomes a floor under the federal funds rate. IORB creates a floor under the federal funds rate. If the actual market rate tries to fall below the IORB, banks would simply keep their money at the Fed instead of lending it out. That arbitrage prevents the rate from falling below the floor. The overnight reverse repo facility. But banks are not the only institutions in the money market. Money market funds, government-sponsored enterprises, and other entities also need somewhere to park short-term cash. These institutions do not have reserve accounts at the Fed, so they cannot benefit from IORB directly. To address this, the Fed uses what is called the Overnight Reverse Repo Facility, or ONRRP. Through this facility, the Fed borrows money overnight from these institutions, accepting their cash in exchange for treasuries temporarily, and pays them a fixed rate. This creates a floor for non-bank institutions similar to what IORB does for banks. ONRRP, a floor for non-bank institutions. Together, IORB and ONRRP form a corridor that pins the federal funds rate within the target range. This is the modern system. It is called a floor system, or ample reserves regime. The modern system, floor system, ample reserves regime. Section 3. How rate decisions are actually made. Now you understand the mechanics. But who decides where to set the target range, and how? The decision-making body is the Federal Open Market Committee, or FOMC. It meets 8 times per year in Washington, D.C. The committee consists of 12 voting members, the 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York, and 4 of the remaining 11 regional Fed bank presidents, who rotate on a yearly basis. FOMC 12 voting members meets 8 times per year. At each meeting, the committee reviews an extraordinary volume of data. Employment reports, inflation readings, GDP growth, consumer spending, housing starts, manufacturing indices, global financial conditions, credit spreads, and much more. They also receive what is called the Beige Book, a qualitative survey of economic conditions compiled from each of the 12 Federal Reserve districts across the country. It includes reports from business contacts, economists, and community organizations on the ground. The Beige Book, Qualitative Economic Survey, 12 districts. The committee also produces what are called the Summary of Economic Projections, commonly known as the dot plot, 4 times per year. Each FOMC member submits their anonymous projection for where the federal funds rate should be at the end of each of the next several years. These projections are then displayed as dots on a chart. Markets watch the dot plot intensely because it signals the committee's collective expectations for the future path of rates. The dot plot, anonymous rate projections from each member. After deliberation, the committee votes. The decision and whether to raise, lower, or hold the rate is announced at a press conference, typically at 2 p.m. Eastern Time. These announcements routinely move global financial markets within seconds. Rate decisions announced at 2 p.m. Markets move immediately. The deliberations themselves are not published immediately. Transcripts of FOMC meetings are released with a 5-year lag. What the public does receive right away is the policy statement, a carefully worded document that signals not just the current decision but the committee's thinking about future decisions. Every word is scrutinized. Policy statement released immediately. Transcripts released after 5 years. Section 4. How rate changes transmit through the economy. Setting the federal funds rate is one thing, but how does a change in an overnight interbank lending rate actually affect your mortgage or your savings account? This is called monetary policy transmission, and it works through several distinct channels. Monetary policy transmission, 5 key channels. Channel 1, short-term borrowing costs. Channel 1, short-term borrowing costs. The most direct effect is on short-term borrowing costs. The prime rate, which is the baseline rate that banks use for many consumer and business loans, moves almost mechanically in lockstep with the federal funds rate. Historically, the prime rate is approximately 3 percentage points above the federal funds rate. Credit card rates, home equity lines of credit, and many adjustable rate loans are tied directly to the prime rate. When the Fed raises rates, these costs rise quickly and predictably. Prime rate reaches federal funds, rate plus approximately 3 percentage points. Channel 2, longer-term interest rates. Channel 2, longer-term interest rates. The federal funds rate directly controls only the overnight rate, but it exerts significant influence on longer-term rates as well, through expectations. If markets believe the Fed will keep rates high for an extended period, long-term bond yields rise to reflect that. Mortgage rates, for example, are most closely tied to the yield on the 10-year Treasury note, which is not directly controlled by the Fed, but is heavily influenced by the Fed's signal about its future path. Mortgage rates tied to 10-year Treasury yield, not directly to Fed rate. This is why the Fed's communication, its language, its dot plot, its forward guidance, is itself a policy tool. The Fed can move long-term rates simply by changing what markets expect it to do, though forward guidance is a policy tool in itself. Channel 3, Asset Prices. Channel 3, Asset Prices. When interest rates rise, the expected future cash flows of assets get discounted at a higher rate, which mechanically reduces their present value. This is why higher rates tend to push stock valuations lower, especially for growth companies whose earnings are expected far in the future. It is also why bond prices fall when yields rise. They are mathematically inverse. Higher rates lower asset valuations. Bond prices and yields move in opposite directions. Higher rates also cool the housing market by raising mortgage costs, which reduces demand and eventually prices. This is intentional when the Fed is fighting inflation. A hot housing market drives up the costs measured in inflation indices. Channel 4, the exchange rate and international effects. Channel 4, exchange rate and international effects. When U.S. interest rates rise relative to rates in other countries, dollar-denominated assets become more attractive to global investors. This drives up demand for dollars, strengthening the U.S. dollar exchange rate. A stronger dollar makes American exports more expensive and imports cheaper, which has complex effects on trade, inflation, and economic growth. Higher U.S. rates, stronger dollar, complex trade effects. It also puts pressure on other countries. Nations that hold dollar-denominated debt find it more expensive to service as the dollar strengthens. Emerging market economies are particularly vulnerable to Federal Reserve tightening cycles for this reason. Emerging markets especially vulnerable to Fed tightening. Channel 5, Confidence and Expectation. Channel 5, Confidence and Expectation. This is perhaps the most underappreciated channel. The Federal Reserve's actions shape expectations of businesses, consumers, and investors. A rate hike signals that the Fed is serious about containing inflation. If businesses and workers believe inflation will be contained, they adjust their behavior accordingly, moderating wage demands, stabilizing pricing decisions. In this way, the Fed can influence inflation partly by shaping the expectation of inflation. This is called anchoring inflation expectations, and it is central to how modern central banking works. Anchoring inflation expectations, the power of credibility. Section 5. What this means for your financial decisions. Let us bring this to ground level. Understanding the Fed's rate cycle is not just academic. It has direct, practical implications for how you manage your personal finances. Practical implications for your financial life. When rates are rising. Rising rate environment. In a rising rate environment, the most important principle is to avoid locking in long-term borrowing. Variable rate debt, credit cards, adjustable rate mortgages, home equity lines becomes more expensive as the Fed raises rates. If you carry a balance on variable rate debt, your costs increase with each hike. Reducing that debt or converting it to fixed rate obligations before rates peak is a prudent response. Variable rate debt becomes more expensive with each hike. On the asset side, rising rates create an opportunity in savings. High-yield savings accounts, money market funds, and short-term treasury bills, which were effectively useless during the near-zero rate era, become competitive assets. Parking cash in these instruments during a high-rate period is a meaningful financial decision. High-yield savings in T-bills become competitive in high-rate periods. For bond investors, rising rates erode the market value of existing bonds. A portfolio heavy in long-duration bonds, bonds with many years until maturity, is most vulnerable. Shortening the duration of a bond portfolio during a rate-tightening cycle reduces this risk. Shorten bond duration during tightening cycles. When rates are falling. The falling rate environment. A falling rate environment reverses the logic. Existing long-term bonds, purchased when rates were high, appreciate in value as new bonds offer lower yields. This is why bonds can be a meaningful defensive asset when rate cuts are anticipated. Long-duration bonds appreciate when rates fall. Mortgage holders with high-rate fixed mortgages may find refinancing attractive when rates fall sufficiently. Businesses with access to capital markets find borrowing cheaper, which can fuel investment and hiring. Equity markets, particularly growth-oriented sectors, tend to respond positively to rate cuts because future earnings are discounted at lower rates. Rate cuts tend to benefit growth equities and borrowers. Cash and short-term savings instruments lose their appeal as their yields decline. Staying in high-yield savings accounts through a prolonged rate cut cycle means watching your interest income erode gradually. Cash yields erode during extended rate cut cycles. The broader point: interest rate cycles are long. They can last years, sometimes more than a decade. The zero-rate era following the 2008 crisis lasted until 2015, and after a brief tightening cycle, rates returned to near zero during the pandemic in 2020. The subsequent tightening cycle beginning in 2022 was the most aggressive since the early 1980s. Rate cycles can last years or more than a decade. Understanding where you are in the rate cycle and aligning your financial decisions accordingly is one of the highest leverage things you can do as an individual investor and borrower. Aligning with the rate cycle is high-leverage financial strategy. Section 6. Common misconceptions. Before we close, let us address a few misconceptions that come up repeatedly. 3 common misconceptions about the Fed. Misconception 1. The Fed prints money when it raises rates. Misconception 1. Rate hikes mean money printing. This is backwards. The Fed expands the money supply when it lowers rates or conducts asset purchases, quantitative easing. Raising rates and reducing the balance sheet, quantitative tightening, do the opposite. The mechanics of money creation are more nuanced than the phrase printing money implies, but the directional relationship is worth getting right. Rate hikes and quantitative tightening reduce money supply, not expand it. Misconception 2. The Fed controls mortgage rates. Misconception 2. The Fed controls mortgage rates. Not directly. As discussed, mortgage rates are primarily tied to the 10-year Treasury yield, which reflects market expectations, not Fed decree. The Fed influences those expectations through its decisions and communication, but the relationship is indirect and sometimes surprising. It is entirely possible for the Fed to cut short-term rates while long-term rates rise, if markets believe the cuts will ultimately rekindle inflation. This has happened. It is a source of genuine confusion for many borrowers. Short-term rate cuts can coincide with rising mortgage rates. Misconception 3. Rate decisions are made by one person. Misconception 3. The Fed chair alone controls rate decisions. The Fed chair is powerful, but the FOMC is a committee. The chair's primary power is in shaping the agenda, setting the tone, and communicating decisions to the public, not unilateral control over the outcome. Dissenting votes happen. The internal dynamics matter. The FOMC is a committee. Dissenting votes happen. Conclusion: the Federal Reserve is one of the most consequential institutions in the global economy, and yet the mechanics of how it actually works remain opaque to most people.